Hello and welcome. Welcome to Open Door, the Open Door live webinar show from Property CEO, which is us. You would have guessed that because obviously there's a big logo up there in the background. I always get that wrong. It's actually this side, that side, whichever way it is. I don't know. It's very difficult to do because I'm looking at a reflection of myself and Ian there in the screen in front of me. Anyway, my name's Richard Clapson and I'm here with the other half of Property CEO, Mr. Ian Child.
Good evening, everybody. Hope you're all well.
He's very polite, isn't he? Very good, very good. Look, guys, it's great to have you here. And just in case this is your first time with us, and I'm sure for a few of you it will be, let us know what let you know what you've let yourself in for this evening. Our aim is to give you 45 minutes of non-stop positivity. We like positivity. We like being positive. I mean, development is difficult enough as it is, so we like to give you nice lots of positive energy, and it's all set around the theme of business and property development. Isn't that right, Ian?
Certainly is. Richie and I run a company called propertyCEO, and basically our day job is training people how to become successful small-scale property developers. So, many people like the idea of developing property, but they worry it's going to be risky, it's going to be complicated. So basically our job is to give them the support, the training they need to do it as safely and as successfully as possible. We also think that right now there's an amazing opportunity really lying just around the corner. We've got all sorts of things going on, recession, we've got the end of furlough, we've got challenges for businesses, we've got the whole COVID thing going on. So at the moment, there's this incredible opportunity for developers, and really wanted to help people find out about it and see if development might be a good fit for them.
That's right. And of course, following the global pandemic, we're still involved in some of that. We don't know where that's going. We're into recession, but hey, come on. Look, here's the thing. Recessions always create opportunities, but of course, only for those that seek them out at the start, rather than, hanging around waiting for everything to settle down. So as always, we'll be serving up advice, predictions. We've got guests. We have a guest this evening. Hopefully that's why you're logging on to see our guest. Probably not just for us, but hopefully you're interested to see our guest this evening. I guess it counts as a bit of training, but above all, we're going to have a bit of fun doing it. We're happy to take questions as we go through. Please just enter them into the chat box. I can see some are coming in already. And of course, if you don't put any questions in, then because we don't have any show. So should we get started? Should we get going and just let's see who's on here tonight? Well, Yoko's on, Debs is on, Simon, Roma, Ritesh, Nick, Ben, Rob, James is on, Jackie, Sammy, George, Stephen, Helen, Paul, Sarah, Jin. Good evening to you all. So welcome. Simon, I was speaking to you earlier in the week, so welcome. Nice to see you on the show. And Ben, I believe, Ben, you were speaking to one of our colleagues, Dan, in the week. So Ben, welcome onto the show this evening. And Yoko's already put a note in. She says, hello, Richard, Ian, good to see you. I was messaging Yoko backwards and forwards the last couple of days. So Yoko, nice to know what you're up to. Keep in touch. Great to see you on this evening. And Debs and Richard says, good evening, both. Looking forward to 45 minutes of non-stop positivity. You're just repeating what I said, Debs, there. That's actually not your line. That's my line. She says, 11 days of quarantine and going four walls crazy. That's because you went away. You went overseas to do a property deal. Now you've come back. It's your own fault. You've got to stick indoors. Mind you, you've got to stick indoors with Richard. Imagine how Richard feels stuck indoors with you, Debs. Anyway, Ritesh says, hi, guys. Great to know that Ian has finally gone to the dark side, investing in a Primark shirt. Oh, Ritesh, I love it. Oh, Ritesh, you're going to get top prize for that.
You can go off people, can't you? You can go off people.
I think that's brilliant. Darren's just joined on. Doral's on. Hello, Doral. Haven't seen you for ages. Trust you're well. Raj is on. James is on. So yeah, people logging on still, which is great. Well, that's all good. But of course, who have we got this evening? Who is our guest? Well, we are very honoured to have back. When I say back, he was sort of here for a very fleeting moment before the summer. We've got the wonderful Will Lucey on from Luc Capital. He's a broker. We work quite closely with Will's firm here with some of our students to make sure they're getting the right advice for their projects and about raising funding. Personally, I've done some stuff with Will and doing stuff with Will, so got a lot of time for him. And of course, last time, some people may remember, he came onto the show. It started quite well, actually. In fact, it was so well because Ian wasn't here. Ian was having a day off at that time, which was quite good. We thoroughly enjoyed that. Probably one of the best shows we've had. But unfortunately, Will's signal disappeared. So we ended about 15 minutes in. I had to cut him short. And then as I was flying solo for the rest of the show. But I do believe he's here. We have done a pre-test this evening to make sure everything is okay. So first of all, Will, can you hear us? Are you there?
I can, and can you hear me properly, please? Hopefully you can.
Yes, we can. And can you turn your camera on for me, Will? Because we'd love to see you as well.
Right, please. Can you see me?
Yes, hopefully we can. So thumbs up if you can. Give us a quick wave if you can see and hear Will, Lucy, please. Yes, they can. Well, as long as it maintains that way, then that is really good. So that's going to be a proper result if it does. Excellent. Sarah's just joined us. Hello, Sarah. Welcome. So we're going to kick off with some questions in a minute for Will. But Will, do you just want to introduce yourself? I mean, obviously, it might be some people don't know who you are. I mean, sometimes we get a bit puzzled, but perhaps tell us a bit about yourself, who you are, what your company is, and maybe you've got to do a couple of disclaimers because we're talking financial stuff this evening.
Of course, yes, thank you very much for that. Yes. So yes, thank you very much for the introduction. So yes, my name is Will Lucey. I have a company called Luc Capital, and we are finance brokers, specialising particularly in property finance for commercial deals. That is exactly a very, very precision thing we do. I do have a couple of disclaimers, just quickly. Any finance I chat to and refer to here is for business purposes only, and information provided does not constitute personalised advice on this particular session. And we are a broker, not a lender. That's it.
But that was simple. I thought we were going to get a whole dialogue then. So I feel quite comfortable. I think we can ask you any question you that we want here. So
I'm ready for any questions. Finance related.
Okay. Did you want to tell us just a bit about how why you do what you do? Because what's a bit of your background, just so people do know?
Yeah, that's always a good thing. Just so you know, I haven't sort of suddenly decided to do what I'm doing a couple of weeks ago. No, my background is actually in accountancy. I studied accountancy from 18 and worked. I didn't actually go to uni. I went straight to work, did evening class, and found my way working for property developers. That's how I sort of came to do this. More and more as I worked up into roles up to sort of FD level, I was more worrying about cash flow and structuring the finance on sites and keeping everything going in that respect than I was actually doing accountancy by the end. So it's something I really enjoyed, and I just love the fact that there's no sort of compare the me account or anything like that. There's no sort of information out there. It really is knowledge you have to go out, extract, and you have to analyze a lot of data and compare a lot of what seem similar deals that actually are quite different.
Good. Okay, so there's a bit of background about Will. So let's fire a few questions. And as always, guys, you can put questions in before the show. You can put them in the week. We're happy to do that. We've got a few as well that's coming in the week, so we can kick straight off. And let's get a question to you, Will. So good evening, Will. So that's a good start, isn't it, for a question? I am new to development, so don't have much or any previous experience, but I do have cash to put into the deal. That's good. If I get a good team around me in line with property CEO training, will I be okay to get funding support for my first scheme? Obviously, we talk about getting a team around you and supporting that. So yeah, the question here, this is Adir saying, okay, if he puts a good team around him, he's got no experience, but he's got some cash, will you be able to get him some funding?
And in essence, the answer is yes, absolutely. So, and you're right, there are various layers to this. So, and the layers are cash in the deal is a big thing. And it is having a good team around you, which I know you are a big advocate of, and you teach that in your sessions. That's really important because a lender will definitely look at the team you have. They'll look at the contractor you have in quite a lot of detail. They may look at the financial strength of the contractor, and they would like to see a CV and past experience of the contractor, because they are obviously the biggest risk in terms of if they went kaput at some point in the middle, it would cause a big headache for not just the developer, but the lender too. So those things are really important. Experience-wise, you still can get property finance without any previous experience. It's just a slightly smaller pool of lenders to start off with, and then you can then move on and widen your range of funders as you go.
Does that mean, Will, for Adir's case here, in terms of if you've got a slightly smaller pool of lenders, the rates might not be as competitive as you might get once you maybe move on to your second project with a bit more experience? Would that be a fair comment?
I think that's fair. That's fair, definitely. Yes.
But again, we're not talking. I mean, I know some people have this perception when they come into this industry that if they don't have the experience, the rates are going to be sky high. But I mean, we're still talking pretty sensible rates of borrowing, even if you've no experience, but you have, as you say, the cash, the right team, the right contractor around you. Would that be a fair comment?
Yeah, I would agree with that. I would agree with that. All in all, it's not. They're still competitive. There's still a competitive environment, even in that sphere. So I would still say the rates are sensible. Definitely.
Good. Good. Ian, have you got a question for Will?
I've actually got one of my questions for Will, if you don't mind, which is what do developers need to kind of plan ahead for? Obviously, we all know that finance is on the radar, it's on the agenda, and we can see that coming. What is it that we need to kind of get our ducks in a row before perhaps we end up engaging with either brokers or lenders? What do you suggest?
Right, this is a good one actually. So there's.
I've been working on that one all week.
Sorry, Ian always comes up with good ones. But there's always some core key things that you need to get right. And that is, if you're coming to actually get finance, even if you're coming to me first in terms of to be going to lenders, what we obviously need is an appraisal document. An appraisal document runs everything from GDV at the top all the way down to a profit at the bottom. Now, the more detailed, the better. You don't have to go absolutely crazy, but the more titles and headings you have in there, like SIL and structural warranty or anything like that, all those kind of things, even if they're zero, they're showing to the lender that you have thought about those costs and you have assessed whether that building actually needs them. That's the first thing. The second thing is the important number in there, particularly for a development deal, is the GDV. Everything is really hinged off the GDV when it comes to development. Now, a lender will definitely scrutinise that. So what would be really good would be to provide some comparables for that GDV. Now, the ideal thing there is if you've got something quite comparable or very similar properties and you've got actual sold prices that are not too old, that's the most ideal scenario. If you don't, then it's the next best alternative. So if are there similar products nearby, or you can get advice or some numbers from agents, but bear in mind that they will probably be a little bit higher than your valuation. I mean, they will be. They will be higher than the valuation you get from a lender. So factor those numbers in. So so once you've got that document and you've got some comparables, the other thing would be who are your team and what are their background and what's your background. And even if your background is not in property development, what have you done? Have you got business experience? Have you managed a team? Have you managed any works at your own house, even if it's minor? Because anything that we can put forward can be credible if you can demonstrate that this person is not necessarily a property person, but they are a professional. They have a background of sorts in business, and that's still something that can be put forward, in my opinion.
Fantastic. And it's fair to say, Will, that the relationship that the broker has with the developer is quite an interesting one, isn't it? Because effectively, once you're satisfied that you're dealing with a credible developer, then you're kind of representing the developer's interests and going to try and find kind of your matchmaking, finding the right lender for that developer, and kind of talking out the developer's kind of credentials with your lending group.
That's exactly right, and that's a really key point actually, where someone like myself can add value, or another broker can add value, because when you come with your suite of information and you effectively are running through the deal with me over the phone or various different emails with information, I can view it and say, well, how would I present this? What's missing, or is there an area of concern that I have? Because if that is the case, it means that we can place it on its strengths. So as you'll know, there's so many different lenders out there, and they all have their different strengths and particular likes and dislikes. And if you can get it right, you can present it in the right way, and it highlight the strengths of that particular lender or group of lenders, and it can massively increase the chances of getting the right kind of finance.
Brilliant. Well, thank you. Fantastic. Any more questions, Rich?
Well, yeah, no, there's a follow-up here. You just talked about future-proofing. Ritesh has asked, by the time the construction is complete, GDV is likely to have changed. How can it be future-proofed?
That is a good point. In terms of that it may have gone down, in terms of future-proofing it?
Possibly, yeah.
I guess there's a couple of comments there. And I do agree that GDV is a funny one in a certain respect, because if you're doing a development and it's a decent sized development or some complex of build, it will be sometime in the future that this GDV will be calculated for.
Yes.
Now, valuers do take this into account. I don't know how they do it. I don't know how they do it in terms of their methodology, but they will take these kind of things into account. So if you're thinking, right, actually going to be marketing these in 18 months' time,
yes,
the valuer will try and take that into account.
Okay. So the underwriters out there, the valuers will look at this. First of all, the qualified valuers will say, okay, you're going to try and put something in the market in that time. Now, one hopes in terms of normal climates, the market is generally rising or level at the very worst. Obviously, times like now, I guess this comes back to them perhaps rethinking loan to values and pulling those things back to give them a bit of coverage ultimately on that estimated GDV. That's probably where they would do this. Would that be a sensible comment?
Yeah, I think that's a sensible comment. I think that from a lender's perspective, they all have various different instructions they give the valuer, and they'll say to the valuer, right, these are your criteria. We want you to give us this price if this happens, and we want you to tell us what's the price to definitely sell them all in X amount of days, or months. And
Yeah.
they'll compare the various metrics, and then in their minds they'll think, well, actually, the value could come down, but we are happy that actually, although we've gone in at 60%, we're actually happy if it ends up being 65. I guess they have their different risk appetites, and they have a bit of fallback as well. So generally speaking, they've built that in. But it normally, as you rightly point out, normally you'd expect it to at least be the same, if not higher. There's no way to really safeguard it, I think is the point. That is quite difficult. What you can do is, and there's another separate point we can talk about, is what you can do is you can concentrate on your exit for your project, and you can have several different exits. And that's what I always say you should look at. Give yourself more time and have a few different exit options.
Yeah,
and then
we always say that, we always suggest to all students and anyone out there thinking about doing development, have definitely 2 exits on everything you do, even if you're adamant that, well, I'm going to have this as a rental, so I'm building it to rent. Well, fine, but you have to have 2 exits because the world changes, as we all found out in 2020. So yeah, that's really, really, really important. Ian, what have we got next?
Got a question here from Dan, who asks, is it more difficult to get funding at the moment? And if so, do you think it is going to be more difficult now there is a recession? Very topical.
Well, it's an intriguing point, actually, because I think that whilst there are lenders that have slightly tightened on their criteria, I think that if a deal is properly placed and the actual mechanics of the deal and it's sold in terms of exactly what's going to happen and the stages of the deal and how it's going to be marketed, and you can really give a picture of it, I still think it's not too far different than it was, in my opinion. I think what's happening is that lenders are concentrating a lot on the exit. They're really focusing on the exit, and they're focusing on, is there enough time in the development? So as we know, there was a sort of brief, this crazy period recently where lots of things have been selling very fast. But that seems to be in some areas. In other areas, it's still selling, but it's taking a bit longer, So lenders are recognizing that, so they're more prescriptive, I would say, in terms of allowing a longer term than normal and thinking, okay, is the exit robust? And maybe asking what the rental is. Maybe they're asking what the rental is now. I mean, some of them are asking that, and you think to yourself, they're probably just thinking, does it work on a normal buy-to-let stress test so that we know this person could probably flip it onto a buy-to-let product? They're certainly doing that if the lender offers a buy-to-let product. They're certainly thinking, we need to make sure it works on our product, and then we know there's a fallback. So it's quite intriguing. However, I'd say on the whole, going back to the point, I'd say, no, look, it is a bit tighter at the moment, but there are still lenders lending, and it's a relatively competitive market out there. So if you've got a good deal with a good profit margin, you thought through your product and where your product will be placed in terms of its pricing and spec, as opposed to what else is on the market, whatever it's coming up, and you know where you sit with your competition, I think that it's there's still a good proportion of deals going through.
Fantastic.
Good
Dan,
stuff.
hope that answers your question.
Good stuff. Okay, just a couple of latecomers. Anthony's on, Garfield's on, Maria's on. And guys, if you've got any questions, please put them in the chat box to Will Lucey. Any questions about finance, he will be happy to help you. And Garfield, good to see you on. I haven't spoken to you for some time. Be great to catch up. Message me, mate. We'll have a chat and have a catch up. This is sort of my personal messaging service as well. But I haven't spoken to Garfield for a long time. So I trust you well, my friend. Anyway, let's have a look. There's a question here that's coming in the week. Helen says she won't be on this evening, but she's going to listen to the replay on YouTube. And by the way, guys, all of these get put up on YouTube. So pop onto YouTube. All the past Open Door shows are there. This one will be up next week. So Helen, by the time you're watching this will be sometime next week. Because Helen's question is, my question for Will, when should or shouldn't you use bridging?
This is a good question. This is a very good question. So bridging, in my opinion, bridging is excellent. This is quite rightly so for what it's used for, and it's really not good if you can avoid it. I mean, you really should avoid it. So if it can be expensive and it's an unnecessary cost, if you can go onto a term finance product. So that's the first thing I'd always look at. What people normally use bridging for, okay, normally what happens is if you're going to buy a development and it doesn't have planning yet. So a development, when you go to purchase it, you can either purchase it with planning or you can purchase it you can purchase it completely planning less, you know what I mean? I'm trying to do the opposite of subject to. But if you either purchase it subject to, which means it's going to have planning, or you wouldn't buy it, or you purchase it at your risk, okay? Now, if you purchase it at your own risk, that means you've got to bridge it, okay? And what that means is a development lender, their numbers don't compute at that point in time because they are basing something on a GDV, which is based on uplifted value. And if there's no planning in place, there won't be any uplifted value that's possible to put on that building or that piece of land at that moment in time. So you have to do a bridging loan, which basically gives you a bit of time to go in, apply for planning, and then once you get that planning, you can then refinance with a development loan. So development lenders, they just won't lend without the planning in place. So that's the first thing. If it's a piece of land you're buying, bear in mind that a piece of land without planning is very tricky. Even on times not like now, it's very tricky. So you really are looking at 40 to 50% maximum LTV and quite expensive rates and quite difficult to get, I would say, at the moment. So bear that in mind. The other thing that you would use bridging for is if you have a development loan. Let's say you have a development loan right now and you're just coming and you've finished your development, but you haven't got much time left, and so you want a bit of an extension of time. If your plan is to sell that development, or perhaps you've sold one and you've got various others still on the market, that's the time to use bridging rather than any other product. And bridging does give the flexibility. Don't forget. So some bridging loans, you can still rent the properties if you want on some of them, and on some of them they will release some of the cash back to you from future sales. So that means that let's just work this out. That means if you were at 60% LTV and you sold a couple of properties, the third one that you sold, you might be able to keep 40% of the proceeds of that sale and give the lender back their 60%, just to keep their loan exactly where it is, if that makes any sense. So it can be a way of releasing a bit of cash early, but that must be agreed by the lender at the time.
So there's a fair bit of flexibility in bridging. They're going to cost you a little bit more money, so you're just going to be careful when you use them. There's a subsequent question that's come in. Anthony's just popped in, so let's just pick this one up. Slightly out of order, guys, so we'll pick this one up. But it says, what is the ideal length for a bridging loan?
The ideal length, that's a really good question. Obviously, there are a variety of different uses. So if you were doing, I think the answer at the moment is as long as possible. That's the trick question at the moment. Because the more time you can give yourself, what you would never want to do is rebridge a bridge because you're just paying extra fees, or you don't want to have to extend it either, or be in breach with anyone, because it's just, it's not a nice place to be. And, bridging lenders are there to assist you. They want you to do well. They want to assist with your property journey, but they do want to be repaid within that timescale. And they have funders that funding lines, which they get their money from, which put them under huge pressure. And they can in turn then put you under pressure. So it is definitely a really good thing to think about the term you need and to add a little bit of slack in. Definitely add a little bit of slack in. So, simple numbers, if we were doing an HMO conversion, let's say, and we bought this property with a bridging loan, and we think, look, it's going to take 3 or 4 months to do the works, and we're going to refinance that HMO onto a term loan, you know, I would definitely leave double the amount of time for the actual build, because you don't know what's going to happen in there. You might get complications, and also I would leave a bit of extra time to refinance it, because, you know, at the moment, definitely lenders are taking longer, valuers are taking longer to come out and report back, and solicitors are definitely slower. I mean, solicitors are definitely slower. So that is all these things I've got to bear in mind. And what you don't want to do is ever be worried, sweating, having sleepless nights. It's just, that's not what it's all about. It's about building a contingency and enjoying what you do without having those.
Well, I have sleepless nights just working with Ian. I mean, you know, it's just a stressful life I lead.
I mean, it's just,
isn't that a coincidence? There we go.
Ian, what do we got for Will?
We've got a question here from Ash, who just asked if you can explain what is mezzanine lending and senior debt, terms that have come across in the kind of the world of finance. What exactly do they mean?
Can we just, before you answer that, Will, because there's a similar question from Raj. Let's answer them both at the same time. Because Raj says, apart from the fact he says hello A-team and Will, which is always pleasant. We're the A-team, Will, you're with us, but not the A-team. So Raj's question is, he says you're all looking good, which is good. He says, could you please explain equity funding when used and combined with other types of funding? So I think if we can talk, if you could explain mezz, debt and equity for Ash and Raj, I think that would be 2 questions for the price of 1.
Let's do it. No problem at all. No problem. Now, all of you would have heard the term first charge and second charge, I would imagine. Okay?
Yes.
So, a first charge is simply where a lender has a first charge on a property. Okay? Now, the second charge holder is a mezzanine lender. That's where they fit in. That's the reason why they charge a lot of money, because the reason is they are second in line to get paid. As opposed to when it comes to senior debt and junior debt, those are just fancy names for a first and second charge. Because senior is just the first charge. Senior debt has the first place. They are the main holder of the charge, and they generally have the largest stake. Junior debt just sits behind that, so it's effectively junior or subordinated debt. There's lots of different names for it, but does that explain it?
Yeah, so I think it's always useful for people, because you say, there's a lot of different names for the same thing. So people often hear these things and think, oh, what is that? So we're talking junior debt, we're talking mezz, any other terms that would be quite common for any of these forms of debt that people might hear that you could clarify this evening?
What other terms are there? So you've got mezzanine, second charge, then sometimes it's called top up, development top up, all this sort of things that you hear. And I think those are probably the main ones. Like, nothing else springs to mind. Okay. But they're all referring to mezzanine finance. But
we're always talking about this junior and senior debt in terms of what we've got in terms of these levels. There's no sort of other formats of it. It's just likely to be a different name. So if someone comes up with some other name, it's just going to be probably referring to one of those levels of investment.
That's right. I think so. Yes. Yeah.
Cool. Raj and Ash, I hope that was okay. And Anthony's question we answered earlier about bridging. Anthony says thank you. So that's good, isn't it?
Wait a minute. We haven't covered equity, by the way.
Oh, God, well done. Go on then. Equity.
I would not forget about that. So equity, right? Equity funding. Okay. How do we describe this? So interestingly, to make it simple, if we say that there's 100% here of these are all, I'll try to get the right way around. This is 100% of all the project costs you have. Okay, you can remember where that distance is. Here's your senior, and they provide this much. So your mezzanine level, or then all the junior or second charge, whichever one you want to call it, then tops up to about this much here. Yeah. Okay. Now the equity is the rest of it. So normally, a normal development lender will say you need to provide the equity, or an external investor or another shareholder, They will need to know how it's made up, but you would provide that. Now, when the question was referring to equity lending, now there are companies that do equity lending, and they work in various ways. So sometimes they will provide 100% of the finance completely, and then in return they will charge not just an interest rate, but they will take 50% of the profits too. So it is a little bit more expensive, but it potentially allows you to do the money the deal without any money actually in the deal. Normally those are for slightly more experienced developers with 1 or 2 projects behind them. So bear that in mind. And other ones, they will do a similar type of scheme, and it will almost be like they're a mezz loan, but they will almost go to 100%. And what they do is they say that what they require from the developer themselves is 10% of the equity needed. So just to put that in perspective, if there is £100,000 worth of costs to do a development, both between the senior or the first charge lender and the mezzanine or the second charge lender, they will lend £90,000. The mezzanine lender, because they're an equity funder, will then top up by another £9,000, and the developer would have to put in 1,000 if everyone was following that. So it actually only ends up being about 3% of cost. And in that scenario, again, they will be looking for a 50% probably split the profits at the end. So bear that in mind. Those products, they are slightly harder to get because they're taking quite a position by putting that level of funding in. So, but they are available. People are lending that now. So it is possible.
Good, excellent. Thank you very much, guys. Hopefully that has answered those questions. What have we got, Ian? Let's throw another one at Will.
Got one here from Ritesh, who asks, in terms of funding, what are the pros and cons of using a limited company SPV? So a limited company to do your developments.
This is a good point. So in terms of purely looking at funding, so I couldn't look at I couldn't say in terms of tax-wise sort of thing. So that would be for them to get personalised advice on. But from a lender's perspective, I would say that I would go so far as to say that they probably prefer limited companies purely from a regulatory point of view. However, it's just as easy for them to lend to a personal person as well, because the choice to use a company normally comes from the developer themselves, because they've had some advice to say, well, actually, I want to ring fence this particular product over here, property over here. Because if I've got 2 developments on, for instance, and one of them goes wrong, it can't suck up the profits from the other one in order to sort itself out. So they are 2 separate things. That being said, if you do lend in a company and you borrow in a company, you will normally be required to give a personal guarantee, which is effectively you sort of backing the loan personally anyway. So needless to say, the lenders sort of get you somewhere to make sure that you're fully committed to the deal. So I would say that you could do either. Lenders probably prefer limited companies from a regulatory wise point of view, but it would definitely be up to you in terms of how you did it. So they definitely take some tax advice in terms of from your solicitor, etc., in terms of what might work better for you, and think about whether you're going to hold the properties or sell them, because that may have implications as well when you're getting that advice.
Fantastic. And say that lenders prefer you to use a virgin limited company when you do so, one that's got no previous history or any other interests or history with it?
That's right. I think that goes along the lines of it just being so much easier if there are no trading history. There's no, other lending or other possible things that may go wrong with a company. The cleaner sheets that the lender has for a company, I think the more they prefer it. I think if it has a long history of trading, if it's been trading at its property developments, it's obviously a bit easier for them to understand, of course. But if it had been doing something else, they do find that a little bit more tricky to get their heads around.
Yeah, no, fantastic. Thanks.
Yeah, I would agree with that.
I think, guys, from our point of view, unless you're going to do a one-off development, the more likelihood is that you will need limited SPVs to do all your developments, each and every development. It's all about mitigation of risk, as Will said. That is extremely important. And of course, assuming that you expect your units to be profitable, you're going to be moving monies around. As Will said, proper tax advice from your accountant here to give you a steer. With all of our students, we actually give them some advice. We get a business broker that works with them to try and steer them and get them the right questions to go and ask their accountant, because it's so important. Because if you don't put these things in place at the beginning, guys, you end up potentially, paying a lot more tax than you have to. And what you can do with SPVs and group holding companies is move the money around in the right fashion, which means your tax bill is going to be potentially significantly less, because you're not taking money ultimately out of the company setup. And so really important to get that advice, but you're almost certainly going to be looking at a series of limited companies. Right, Raj's question earlier when we talked about equity and MES and that sort of thing, along with, I think it was Ash or someone, he says, thank you, Will, well explained. Well, that was good.
Excellent.
It's nice to get a bit of feedback, isn't it?
It's all good to get feedback, isn't it?
Yeah, it's good. Yeah, I mean, I thought you were doing rubbish, but I mean, that's very good, Will. Okay, Will, we've got a few questions here on PGs, so I'm going to string a few of these together. So let's have a look. So Sarah says, I'm going to read all three out, and then we can take the bones out of it. So Sarah says, I'm told I will need to give a PG, that's a personal guarantee for those that aren't aware, to the funders. What if things go wrong? Will they come after me for the money? So that's one question. Garfield's put a question in, and Garfield says, hi, Richie. That's great. We're doing a little bit of toing and froing on the message front here, just getting a little bit. We could do this on social media, I guess, but not on the webinar. So he says, hi, Richie. Would equity lenders take a PG as they are taking a higher risk? And then the next question in from Ritesh. Ritesh is getting a lot of questions in life, but they're good questions. He says, can you get PG insurance? So 3 questions here. Will funders chase you if things go wrong for a personal guarantee? Will equity lenders take a PG as well? And can you get PG insurance?
Right, let's get going.
You take a 50-50 or phone a friend.
It's 3 questions, I'll remember, 3 points. So the first one is, yes, look, it is, whilst obviously whilst all PG documents or personal guarantee documents will be slightly different, and obviously your solicitor needs to advise on it, so you know exactly, of course, can't advise on it, but personally, you of course will be on the line for that money. Now, I don't know, different lenders will treat this in different ways in terms of how they recover their money if something could go wrong, and whether they use it as a last resort or they use it as a threat or they use it as a first resort is completely up to the lender, and it will vary in terms of what's in your personal guarantee document. Now, lenders know this, and they know that it's quite detailed. So what they normally always make you do is get independent legal advice just to sign your personal guarantee. Okay. Now, when I say independent, I mean you can't use not the same solicitor that you're using for the completion of the loan. It has to be a different solicitor. Sometimes it can be a different solicitor within the same firm if the firm's big enough and the lender allows it, and sometimes it has to be from a completely separate firm. And the reason is because they need that agreement to be robust and they need it to be understood, because it definitely will be a document where they will be able to pursue for the money. That's for sure. I'm trying to think what the second question was.
Okay, well, I can't remember that because I've scanned over it. So we have one, which is will they pursue it? So that's the first thing. Will equity lenders take a PG as well?
Right, and the answer is yes, they definitely will take one as well, because like you said, they've got quite a gutsy position there. So they're on the line. They want you to back that loan, definitely.
And the final one was, can you get PG insurance?
Well, I'm aware that you can, yes. And that is purely because of clients that we have that have got PG insurance. So that is purely a way up. It is possible to do. So it's aware of what that cost is, and of course get some, I'll bang on about everything, but get some good advice. Get a good insurance broker on that. Make sure it's with a funder and you understand the terms so that you understand what you can claim for and what you can't.
Yeah. I think the thing is yeah, guys out here, in terms of if you're thinking about doing development and you're going to go and put your neck on the line and go for it, you've got to be confident. You've got to know you've got a robust deal. You can't just assume, well, okay, what if it goes wrong? Well, I don't really want to have a PG. You should be 110% confident that you're going to sign a PG and it's not going to be a problem. The way that we always work with new developers, to train new developers, is to try and show you how to mitigate your risks. It's very easy to go out there and think you're going to be excited to make loads and loads of money, and indeed you can. But the first thing is about mitigating your risks. You want to end up with this thing stuck on your back. Keep your shirt on your back at the end of the deal. So the worst position that we would like any of our students ever to be in is that they break even. Never in a position where PGs get called in. And I think if you approach development right, you have a good robust deal analysis. We've been talking about predicting GDVs and all those sort of things. You should never be in a position where a PG gets called in. Now, there is always the other side of it. If you're ever in trouble, then shout, put your hand up, don't get your head in the sand. Right, Ian, have we got another question? Oh, by the way, Ritesh says great response, Will. Ian, have you got another question? Let's see if we can fit one or two more quick ones in.
Well, I was just going to reinforce that one point you made right at the end, because I think it's a really important one about the communication. So if things do go wrong and you do end up in a situation where you're worried about PGs and stuff like that, then do not bury your head in the sand. Go and talk to your broker, go and talk to your lender, and because these guys, they're not new to development. They know that there are bumps in the roads. What the PG is for is to stop people throwing the keys back and running to the hills. If you're a developer who is able to you've got a team around you, you can find a solution and work your way through it. That's music to the ears of a lender. And of course, the way in which they guarantee that you're going to do that, they've got a PG. So that I think is kind of worth just laboring. I hope you agree, Will.
Do you know what? I agree. The thing is I agree with the communication point. If anything goes wrong, get on the phone, get straight in there, and obviously and take action. So just go in there and say, look, I tell you what's happened is this has happened. Don't worry, we're on the case. We'll do all we can. And if they know that, it does fill them with a huge amount of confidence. You do get sometimes you do get a borrower who sort of keeps quiet and not quite sure what to do. It's much worse. No news is definitely much worse than bad news, because then they've got this open dialogue. They understand where the position is. You don't feel that the lender is completely blind. They have not seen the development. They rely purely on their QS and their valuer. That's right. So they like to know. They like to know the detail.
Fantastic. Thank you. So one question about should you put together a pack for investors? So you talked earlier about some of the information that they would like to see. Should you be putting together some sort of documentation?
Yeah, do you mean for lenders?
Yeah, for lenders, yeah.
Lenders, sorry, yes. Yes, definitely you should, yes, yeah. I think once you've got your appraisal document with the team behind it, and what's really good, actually another thing, as just to mention, if you've got past experience, if you've done a few projects, really go to town on those. If you've got some pictures before and after, and you've got a little bit about the kind of build that you spent on it, the build budget, and what you did, maybe there's a few problems that you overcame, things like that. It goes a long way if you've got a report, and I can say, experience-wise, here's a document showing exactly what this particular applicant has done, and here was a few problems they overcame. And yes, there might be even smaller scale than the one we're going for, but you can see that there's a small build-up. They've done some smaller projects, they've built up, and they've gone well, and they've gone to plan. It really does build huge credibility. The other one is, as I say, the comparables, really big one on that one, because they start digging in straight away, development lenders, saying, well, in this area, is that going to sell? Because they know that's how they're going to get repaid. That's absolutely concrete for them. So those kind of costs this kind of information are really, really key. When you have numbers from agents, that's all great. Maybe get 2 or 3 sets of those, because they do tend to vary. And when you're then looking at those numbers, bear in mind that the development lender will more than likely instruct their valuer to say, give me a number where all those properties at the end are going to be sold within 6 months, no questions asked. Absolutely, definitely going to be sold within 6 months. So if you think the valuer has got that particular hat on, I would actually go to the agent and say, right, well, let's say I've got to sell this within 5 months. Give me a price where you just absolutely it's going to go, and then at least you compare that with what their normal marketing price would be. It's definitely useful for you to see that and plan, because the valuer will generally come in lower than the agent's numbers. So just do bear that in mind, because it can cause a bit of upset or a bit of not just annoyance, but I guess a kind of disappointment when you think, well, actually I can get this kind of funding and it's all working, and it comes in a little bit less. So just bear in mind it will probably come in less, and plan for it up front, I think.
Fantastic.
Yes.
Thanks, Will.
Great stuff. Well, I'm going to fire one last question. I need a very quick answer because we're slightly over on time. But Karen says, at what stage should I think about making inquiries for funding a project? At what stage?
I always say, quick answer to that would be, have a chat with the broker very early on, just to say, look, I'm looking at these kind of projects, give you some advice. What do you think? This is my cash resources. This is my experience. Those are really good. But most people, once they've identified a deal, and they think this is going to be one, I'm going to put an offer in. If you're at that point, that's, I think, the chance, the time to come to a broker and say, look, I think I'm going to have to start getting some terms on this, because I'm going to put an offer in on Monday, or ideally give me a bit more time than that. But in a week or so, I'm going to put an offer in, and I want to know roughly where I stand now, even though it won't be a full application. Start that process early. That's what I would say.
Karen, there you go. And on that note, Will, can you give out some details if people want to contact you? We will put these in the show notes on YouTube and on our website. But what's the best contact for people to get hold of you?
Yes, please do get hold of me with any questions, or if you want to chat finance at any point in time. I seem to love it. My mobile number is the easiest way to get hold of me, which is 07 886 279 773.
Can you just say that again for people? Just grab a pen, guys and girls, grab a pen, and Will is going to say his number one more time.
Okay, and that number is 07 886 279 773.
And an email address?
Email address, yes, is Will, WILL, at Luc Capital, and that is LUCCAPITAL.co.uk.
Great stuff. And what we do is we put Will's details and his website address and everything on the show notes, so you can pick those up. I know a lot of people listen to this on the replay, yeah, all you guys that listen on the replay, you'll see them there as well. Well, thank you. We got through it today. No internet problems at all. That was fantastic. So thank you very much. Hopefully you've enjoyed it. We've enjoyed it. Let's just get a bit of a give us a wave if you enjoyed Will this evening. Give us a quick hands up if you did. Yes, we did. Yes, unanimous. Well, perfect. That's great. Well, thank you very much. We'll let you go and enjoy the rest of your evening, and thank you for your time.
Thank you very much, gents. Thanks for having me.
Cheers.
Well, that was good, wasn't it?
Very good. Informative, yeah.
Yeah, good stuff. Okay, guys, let's try and wrap the show up. We won't keep you any longer. Hopefully you've enjoyed that. We will put Will's contact details. Please reach out to Will. Hopefully you found it very useful. We tried to get as much information as we could within the time. Next show, obviously, we're now running these shows once a week. So Thursday nights at 7 o'clock. Put that time in your diary. We'll always be here. And our guest next week, this is going to be really interesting and really quite exciting. We've got one of our mentees on, one of our students, a chap called Dominic Perrin is coming on. He's a bit of a character in all senses. He's actually an airline pilot, and he's coming on to talk about his journey, his transition from where he has been and where he still currently is to an extent into the world of property development. So that's going to be really interesting to come and ask some questions to someone who is out there doing it. So for all you people out there that are thinking of doing it, not quite sure, whatever, come and ask Dominic some questions, come and listen to some of his stories. Hopefully you are going to find that of interest. Anything to add, just to say, Ian, before we sign off?
Just to say, if you've got any questions for Dominic, then please do fire them in during the week, and we will answer them live next Thursday evening at 7 o'clock.
Great stuff. Just let us know in the chat box as we sign off if you've enjoyed the show. Any last comments on there is quite nice. If you just say, yeah, that's great, we enjoyed the show, pop it in the chat box as we sign off. It's always useful to know and get a bit of feedback to know that you've actually enjoyed it. So guys, yeah, hopefully that's been good. We will see you next week. And there's a few comments popping in. So Anthony says, thank you guys, great value. Ritesh says, wave, but that was from just now. Yoko says, thank you so much. Rob says, as always, interesting and informative content. Thanks, gents. Great session. James says, great, thank you. And Nick says, good show as ever, guys. Thank you. Thank you, Nick. Thank you, everyone. And we'll see you next Thursday evening, same time, same place. See you then. Bye-bye.
Bye.